Hi, my name is Will from CoSec Kadari Securities, and today we're going to be discussing how macroeconomic events have the potential to shape commodity prices and in turn shape the prices of Australian companies that produce those commodities. In particular, we're going to be looking at individual examples of gold, iron ore and oil. This is going to display how investors can make more informed decisions by actually closely watching macroeconomic events.
As usual, any information given is general in nature and it doesn't take into account your personal needs or objectives. For further information, visit our website at www.cosec.com.au. So today we're going to be discussing how macroeconomic events have the potential to shape commodity prices and then go on to influence share prices in Australian companies. In particular, we're going to be looking at individual examples of gold, iron ore and oil, and we're going to display how by closely watching macroeconomic events, investors can make more logical investment decisions. Throughout the economic principles of supply and demand, global events can cause fluctuations in commodity prices. Major events, economic activity, and trade policy changes will directly influence the supply and demand of a commodity. Put simply, an increase in the demand for a certain commodity will result in an increase in its price. This is because more buyers are now competing for a resource that has limited supply. The opposite applies for a decrease in demand, which will lead to a decrease in price. If the supply of a certain commodity increases, its price will then fall. This is because the same number of buyers are now competing for a greater quantity of the commodity. The same implications can be set for a rise in price, which would cause a fall in demand and vice versa. To display this relationship using supply and demand curves, here is a more in-depth graph. Now, initially, this economy is in equilibrium, with supply curve S and demand curve D1 showing a price of P1 and a quantity of Q1. Now, an increase in demand shifts the demand curve up and to the right, resulting in a greater quantity, Q2, demanded at a higher price, P2. Now, remember, hundreds of forces are pulling at the strings of commodity prices at all times. Therefore, these basic principles may not always hold and are subject to a variety of influences. Often, investors seek to directly benefit from fluctuations in commodity prices. However, the miners, extractors, producers, and distributors of a commodity can also be beneficiaries of price movement. Australian listed companies can either benefit from or be negatively impacted by these price changes. This impact will be reflected in the company's profits, revenues, cash flows, and earnings, and as a result, the company's share price might appreciate. Now, we can take a look closer at a couple of specific examples. So let's start off with gold. Gold has been used as currency, jewelry, and more recently in electronics. It was historically used to back the US dollar, but in 1971, Richard Nixon put an end to the gold standard. In terms of supply and demand, gold finds itself in a very interesting situation. Unlike many other commodities, once refined, gold is not a consumable commodity, and the supply of the metal has gradually increased over time. Yet with an increase in populations, demand has also grown. One of the major impacts on the price of gold is the health of the macroeconomic environment. So gold is seen as a defensive investment during recessions, currency volatility, or fear of market volatility. Foreign exchange movements also affects the price of gold. For example, when the US dollar is strong, the price of gold is generally low. When the US dollar is weak, gold prices generally rise because more gold can be bought for less US dollars. Now, in Australia, if our own dollar is low in comparison to the US dollar, Australian gold miners benefit from the exchange rate because gold is traded against the US dollar, so margins will increase. So central banks also play a key role in the supply and demand of gold. They will keep gold reserves off the market and work closely to stop the oversupply of the precious metal. Further, prices can also move depending on the amount of gold produced each year, as the demand for gold could be washed out by oversupply. As time goes on, it is logical that all the gold near the surface level gets processed, and the miners either need to discover new sites or mine deeper to maintain the same production levels. If demand for gold exceeds its supply, prices will rise. In the early months of 2020, market uncertainty rose due to COVID-19. As political turmoil and market doubts persisted for many months. Now, the investment committee believed gold was due for appreciation in price, as shown on this chart. Here, gold can be seen to steadily rise towards the $2,000 mark. Now, on the 22nd of June 2020, COSEC sent out a hot opportunity for Saracen Minerals, which we believe would benefit from this rise in price. In the following months, Saracen rose by over 30%. So let's take a look at our next example of iron ore. So iron ore is one of the world's most vital commodities, 98% of which is used in the production of steel. Now, the production of iron ore is most often a function of the general level of economic activity due to its application in production of such a wide range of goods, including buildings, cars, machines, ships, and electrical appliances. When industrial production of these goods and infrastructure projects increases, the price of iron ore has a tendency to rise also. As the largest consumer of iron ore, Chinese demand has a significant influence on its prices. For example, Australia's close trade relationship with China sees miners such as Rio Tinto, BHP, and Fortescue Metals satisfy China's industrial engine with large quantities of iron ore. As a result, in 2011, the price of iron ore rose to $187 per tonne. Another major influence is the miner's operating cost. The more cost-effective a company can mine the iron ore, the more competitive their prices. For example, in 2015, iron ore prices fell as producers around the world operating at very low economies of scale ramped up their production while Chinese demand fell. This resulted in oversupply of iron ore, hence the fall in prices to $41 per tonne. In 2019, COSEC identified that the collapse of the dam at the Vale iron ore mine in Brazil would have major implications on the iron ore markets. This event led to a 40,000-tonne shortage of iron ore globally, resulting in a rise in its price and allowing Australian miners to take advantage. So this chart here shows the significant increase in prices over the following months as demand exceeded supply. So this chart shows a corresponding rise in the share price of Australian ore producer Fortescue Metals over the same period. So finally, we take a look at oil. So oil is the most traded commodity in the world and has applications in a variety of transport fuels, electricity generation, plastics, and other synthetic materials. Oil is commonly separated into West Texas Intermediate, or WTI, found in the US, and Brent oil, or crude oil, found in the North Sea. Oil is most commonly bought and sold using futures contracts. A futures contract is an agreement between a buyer and a seller to exchange a predetermined amount of a commodity at a future date. These contracts are heavily traded by two major parties, hedgers and speculators. Hedgers are generally interested in owning a futures contract at the time of its maturity. As indicated in the name, hedgers aim to hedge against the risk of potential movements in the commodities price. They want assurance that they will receive a certain amount of commodity at a certain price on a certain date. An example of this would be Qantas. They may purchase jet fuel in advance to protect themselves against fluctuations in price, giving them more certainty about future cash flows. Speculators, on the other hand, do not have the intention of receiving the commodity. Instead, they aim to profit from the fluctuation in the contract's price. For example, in early 2020, the May WTI futures price fell to negative $37 per barrel. Now, this is the first time in history the price had ever turned negative. This was due to the intense short-selling speculation coupled with oversupply as global demand collapsed amid the COVID-19 pandemic. This saw net profits after tax of companies such as Oil Search fall by over 100%. On this chart, we can see the very sharp drop-off of the price of WTI and its sharp rebound. During the crash, COSEC research team identified the irrationality behind short-selling the commodity and identified Beach Energy as a domestic oil company that might benefit as prices rebounded. Likewise, this chart of Beach Energy shows a fall in price and a quick rebound in the following months.
So the examples that we looked at today of gold, iron ore, and oil displayed how by watching closely the macroeconomic events all around the world, we can identify any movements in price of the underlying commodity, and then in turn identify companies on the ASX that could potentially benefit from those moves. This presentation was brought to you by COSEC, Qatari Securities. Thank you and have a nice day.